Welcome everyone. We'll just wait a couple of minutes to get started. Just wait for some people to join. Thank you. Just wait for a few more people to join. Won't be a minute. We'll get going. Great, I think we'll get started. So, tēnā koutou katoa, very warm welcome to you. My name's Cath Lomax and I'm the Chief Client Officer here at Fisher Funds. And we're really grateful that you could join us this afternoon. And for many of you, you joined us in the first Financial Wellbeing for Women webinar. And we had lots of questions, which was fantastic. So we've really focused this presentation around answering some of the jargon that we hear in financial services and what that means for you and some of the myths that are around. So today I'm joined by Victoria and Laura, so welcome both. They're very experienced advisors here at Fisher Funds, and they're going to take you through a short presentation and then we'll have time for a few questions at the end. So a couple of things before we get started. Firstly, your attendance isn't visible to anybody else. Today is information only, so it doesn't take into account your own financial situation, but we have a great team of award-winning client services and advisors that you can email, click onto live chat, or go and visit our website or call us, and we'd be more than happy to help. And then lastly, the webinar is recorded, so you can go back and watch it at a later date or come back at any time. So we do want to hear from you. So down the very bottom of your screen, you'll see a Q&A button. So if you want to click on that and type your questions, we'll do our very best to answer some of them near the end. And if not, as I said, we've got a great team of advisors here and client services, and we'll be able to get back in touch with you to answer those questions. But feel free to contact us. So a little bit about Fisher Funds. So as many of you know, we provide managed funds and Kiwi Saver for a range of New Zealanders, and we have over 250,000 clients. We're really excited. As I said, we've got award-winning client services and we've got lots of awards listed down the very bottom. But we're really about helping our clients achieve their goals and achieve their investment dreams. It's a very busy and exciting time here at Fisher Funds with the pending acquisition of Kiwi Wealth. And we think that's great. It's going to provide a combined organisation, is going to provide even better retirement outcomes for all New Zealanders, which is something that we're incredibly passionate about. So that means better and more client services and value for money into the future. So really exciting times. So why this webinar today? So as many of you know, the Financial Services Council, in conjunction with the Retirement Commission, undertook some research late last year. And one of the key findings in that research was that 60% of New Zealand women rate their investing literacy as low. And that's something we really want to change and help progress with in New Zealand. So today is about how we can improve women's investing literacy and build confidence in our financial wellbeing. So today is for you that are listening or coming on board, but also it's open for everyone. So please feel free to share the information and help women in your lives with this. So Laura, I'm going to start with you. So one of the questions in the first webinar we received was, can you please do an investment 101 that explains everything in a really clear way? So big task. Over to you to start. Thank you.
Yeah, thanks, Cath. That is a big task, but we thought actually the best place to start might be with our own product disclosure statement, if we can bring that up. So when investors are getting information and comparing funds, you're commonly going to be faced with a summary that looks something like this. And obviously these conventions, they're designed to be as clear as possible, but we also know that for many people, it's written in basically a whole different language. And, you know, investing really does have its own language. Our goal today is just to highlight some of these key terms that you're going to hear again and again when you're engaging with the investment industry. So we will come back to this slide later on once we've had a look at some of those really common words. But first off, let's just start with the basic question, you know, why do we invest? Well, investing is a way of creating wealth without having to be paid to do something. We call that wealth creation capital gain. So capital is the money that you start off with to invest. Gain is the increase. So capital gain refers to the amount of money that you can expect your original investment to increase by. So there's going to be two distinct categories of investing that you hear about again and again: income and growth. So let's look at income first. Income investing, it's a category of investing which is often referred to as conservative, and that's a word you're going to hear a lot again. Conservative, though, doesn't mean it's risk-free, and in fact, this has been a particularly tricky year for income investors. But in general, you're going to see less extreme ups and downs with this category, and I'll explain why. So there's a few terms that are almost largely interchangeable: income investment, fixed income, and fixed interest. So they all refer to the defining feature of this type of investment. There is a fixed interest rate, also known as a coupon, for a fixed amount of time. Yield's another common term that you're going to hear that refers to this income return from the investment. So one type of income investment many of us are familiar with is term deposits, so it's quite a good place to start. Term deposits are through regular banks, and they usually have lower interest rates than most fixed income because they're considered to be very low risk to investors. The general idea, though, is the same. You receive a fixed interest rate for a fixed period of time in exchange for letting the bank have your funds throughout the investment term. But when it comes to income investing in a managed fund or a portfolio, you're typically lending instead to a government or corporate issuer. They, again, are paying you a set interest rate for the privilege of using your funds to help finance their operations. And then what they do is they repay back the investment holders at the end of the set term. So the most common type of investment you're going to hear about in this category is called a bond. So we thought that we'd give you a bit of an example of what exactly a bond is and how it works, because again, that's something that we get questions about all the time. So here, what we've got is an example of a bond with a duration of 4 years until it matures. The interest rate or coupon or yield, all the same thing pretty much in this example, is 5% per annum. When the bond is first issued, its price or face value is $1,000. That $1,000 gets given to the issuer for them to use as needed throughout the term. For the next 4 years, the investor gets $50 a year in interest on their $1,000 investment. When the term ends after 4 years, the bond is said to have matured, and then as the investor, you get repaid back the face value of the bond, which was $1,000 in this case. So one big difference versus a term deposit is that with bonds, there's a market where you can actually buy and sell the bond that you own to someone else if you wanted to get cash from the investment earlier than a term, and you don't have to wait for it to mature. However, this does mean that its value is going to change, rising and falling on a day-to-day basis based on how attractive the bond is in the current market. So if interest rates are rising and other investors decide that now, hey, they need 6% to make it worth buying a 4-year bond, they're only going to be willing to pay you slightly less than what you paid originally. In recent years, we actually saw the opposite of this. So many bonds were trading for more than their face value as interest rates up until this year basically were falling. And this meant that older bonds with the higher interest rates were more attractive than when they were originally issued. So it does go both ways. But although bond prices do go up and down throughout their term, the key thing to remember is that there is still a set interest rate, and investors who hold the bond until maturity will be repaid the face value of the bond when originally issued regardless. This means that the ups and downs should be less than for growth investments, which we will learn more about now.
Yeah, I'm going to take over Hi everyone. So the next asset class we're going to be looking at is shares. So first up, shares are also referred to as stocks, and they are bought and sold at a stock exchange or the stock market. Now this terminology derives from the sale and purchase of actual livestock in an actual market. And sometimes it helps us to remember that, because the behavior of markets can be so much more readily understood when we think of it in terms of what they are, which is people buying and selling things, prices going up and down based on a number of factors, and some people getting good deals and some people not. So getting back to today, we're not referring to cows or sheep or horses, and we prefer to use the term shares or equities. So a share or an equity is actually part ownership of a company. A shareholder is a person or a legal entity who owns those shares in that company. And the share market or the stock exchange, as I said, is the place where those shares are bought and sold. So you buy a share for a certain amount of money, and when you sell it, you can either do so to make a profit, so you sell it for more than you paid for it, or you realize a capital gain. So capital being the money you started off with, gain is the increase. So capital gain therefore refers to the amount of money you can expect from your original investment to increase by. So not unlike selling a house for more than you paid for it. So what is a shareholder? Well, shares differ from houses in lots of different ways. Firstly, they are something we call liquid, which means they're easy to buy and sell. Because you're buying part ownership of an actual living, breathing company, you have the opportunity to invest in all sorts of different industries and countries. So imagine you buy shares in an iconic New Zealand company like Fisher & Paykel. So they're New Zealand based, but a large part of their manufacturing and sales of their products actually takes place overseas. And some shares, like Fisher & Paykel, may also pay what is known as a dividend, which is an actual share in the profits that company generated each year returned to the shareholders. Not all companies choose to do this, though. Many prefer to reinvest their profits back into the company itself to help it grow. Investing in shares is something that people can do directly or indirectly. Directly via online platforms like Sharesies, Hatch, or Tiger Brokers, or in a managed fund, which is what Fisher Funds is. So this brings us to our first myth of the day: property is your only option. It's become almost Kiwi law that the best way to achieve capital gain is to buy an investment property with the money that you have borrowed from the bank and get tenants to pay down the mortgage for you. And then at some point you sell the property, or you use it as collateral to borrow more from the bank to buy another one. And when the time comes to sell, you rely on property prices having increased, and voila, you've got your risk-free capital gain. But is it really risk-free? Well, no. And as a generator of capital gain, it does rely very heavily on New Zealand's incredibly skewed tax-free status bestowed on property and on capital gains from property sales. It's held very firm in the heart of Kiwis, but it does create quite an uneven investment playing field. Other downsides of using property as your only asset class: you can't sell pieces of it when you need cash. When you do come to sell, it can be quite a lengthy process. It's not simple. So if I buy a house for me to live in, well, capital gain is probably a secondary concern because I have to live somewhere. But if it's an investment property, then the questions I need to ask are more along the lines of, is this return going to be guaranteed? What are the risks that I don't achieve that return? So what are the risks of owning a property? Well, the first one would be capital loss. When a property is sold for less than what you paid for it, then it's a loss. And this can occur because the house value was not maintained, or it was damaged in some way, or as we're seeing at the moment, property market's actually going backwards. So this brings us to a concept that we commonly talk about: risk versus return. Does the expected return on the investment justify the risk in making that investment, Laura?
Yeah, so risk and return, they're concepts you're going to hear a lot in the investment world. Risk and volatility are often used interchangeably as terms. So risk and volatility both refer to the possibility that you could lose all or some of your investment. Different kinds of investments have different risk factors. When we say an investment is considered to be lower risk or less volatile, That means that the ups and downs of the investment are likely going to be lower, and that there is less risk of a large or complete loss of your investment funds. The tricky bit, though, is that we often think about risk in everyday terms as 100% a negative. But that's actually not the case when it comes to investing, as additional risk is linked with additional return potential. In fact, the term higher risk is often used interchangeably again with higher return or higher growth when we talk about investing. The extra return potential is what you're getting paid as an investor to compensate for taking additional risk. So as an everyday example, think about who you would lend to if you had a business financing loans. You might feel very comfortable to lend to an individual with a long, stable credit history who earns a good income, doesn't have any other debt, and you'd probably be offering them quite a competitive interest rate. However, if you are going to take on the additional risk of lending to an individual with a low income and high level of debt, you'd probably only take the risk if you were able to charge a very high interest rate. So that's the relationship between risk and return in a nutshell. As investors, we're only going to be taking on additional risk if we expect additional return. So this chart shows the relationship between risk and return for different kinds of investment. You can see that cash has the lowest potential return as it is the lowest risk. But as we move up through bonds, property, and then into shares, each of these asset classes have slightly higher risk and potentially higher returns. So we're not saying that you should just pile into international shares because they potentially got the best returns because they're the highest risk. Every investor is going to have their own sweet spot where they balance risk and return in line with their individual risk profile. The goal is just to optimize the long-term return that you need to meet your goals without taking on more risk than is necessary. But unfortunately, taking no risk at all is not going to meet a growth goal.
Okay, thanks, Laura. So let's start to bring all these ideas together. Return is made up of two distinct things. The first is income. When you invest in bonds, that income derives from the yield, as Laura explained. And when you have shares, this income is derived from the dividends, which are paid by the company to its shareholders. Capital gain is something that is generated by the increase or the decrease in the price of the asset as determined by the buyers and the sellers participating in the market where that asset is traded. So in this graph, we're looking at the S&P 500, which is an equity index. As at the end of September this year, the return was 9.4%, of which 7.8% was generated by earnings growth in the shares of the companies listed on that exchange, rising, and 1.9% was generated by the dividends those companies paid out to shareholders. Laura, can you take us through our next investment myth?
Yes, okay, so if we bring our next myth up, one of these myths that we frequently face is that investing is basically just the same as gambling, and this really couldn't be further from the truth. While the outcome of a coin flip or a horse race has you pitching your money against the odds for the outcome you want, whether it's set by statistical probability or the TAB, or in the case of the picture here, a casino, where the odds are going to be strongly stacked against you. Investing in the growth potential of companies operating in the real world is not just pure speculation. As a reminder, as Victoria commented on earlier, investing is actually about buying or lending to real life businesses. So as an investor, you can proactively select well-established quality companies with solid prospects to help guide that decision making. You aren't just purely depending on luck to get a good result. So while there can be quite big swings in investment values in the short term, over time, volatility is smoothed out to create more stability to those returns. So that's what you can see on this chart here. It shows the actual historical returns over different time periods in the US market, share market, when I say market. So over a 1 year period, the range of returns that investors received, it varied hugely from nearly plus 50% in the best year to nearly negative 40% in the worst year. However, as we look at those returns over longer term time periods of 5, 10 or 20 years, The range of returns narrows significantly. And the 20-year range of returns is the narrowest box you can see, where the range of returns have historically always been above the line in that positive range. So picking investments selectively and investing appropriately in the right mix for your time horizon are key ways to reduce the long-term risk of investing. And then another term you're going to hear a lot when it comes to reducing investment risk is diversification.
Yeah, I love that slide, Laura. I'm just going to jump in there.
Yeah.
But whenever I buy a lotto ticket, my daughter's always saying, put the money in somewhere else, Mum, where it's going to actually give you a return. So there we go.
Oh, that's good. You've taught them well.
Victoria, yeah.
Oh, right. So,
yeah.
Diversifications, yeah. So as Laura was saying, diversification is something that we talk about a lot, and this table may look familiar because we talked about it in the first webinar, but it was something that overwhelmingly people asked us to talk about it again. So let's do that. So we know in theory we need to diversify, but it speaks, and that speaks directly to what Laura was mentioned before. Shares equals risk, because aside from being too simplistic a conclusion, the real risk to investors is always a lack of diversification or being too exposed to one particular asset class. And you know, you may recall from my last time, one of my favorite investing adages is don't put all your eggs in one basket. Spreading your eggs across different baskets helps you to make the most of different market cycles and the way that those market cycles impact the different asset classes at different times. So the slide that you can see is showing how important diversification it really is. And when you see the pale green highlighted square, that is the top performer for the year, and the red is the poorest. And what is abundantly evident is there is no pattern here. There's no overall winner. Some years it's New Zealand equities, other years Australian international shares, sometimes it's bonds, property, and rarely, although this year is an exception, it's cash, as represented by the last column. So what we're looking for as investors is that sweet spot that's neither first nor last, but solidly performs throughout all the different business cycles. And that's what diversification gives you. It assists you to generate long run returns that can weather the ups and downs across all the different asset classes. Which brings us to our next investment myth, Laura.
Yes, so we hear this one a lot. A popular investing myth is that timing the market to maximize your gains and avoid any losses is realistic. The problem is, unless you have a crystal ball, to time the market, you need to make two extremely tricky decisions. First, you need to know the absolute best day to sell. And second, you need to know the right time to get back into the market, so you don't miss out on the opportunity of missing out on the market recovery, which can often happen quite quickly. So not only does this require a superhuman level of insight and luck that, by the way, I don't believe any investment professionals throughout history have been able to get consistently right, but it also goes against human nature. Not many people are racing to sell when the market is hot, and even fewer have the courage to wade in and buy just when things are at their absolute worst. In fact, what we see is most people who try to time the market do exactly the opposite of that. So this graph here shows annual returns in our Kiwi Saver Growth Fund as an illustration. As you can see, the market can turn pretty quickly from year to year, and short-term returns can be extremely variable. So a lot of people tried to time the market in 2020, which was forgivable given the market environment, by switching to cash or a more conservative fund. The problem is that since in 2019, no one knew COVID was coming. Many people only made this decision only after the market had already really fallen in 2020. The next problem for people who made that choice was then realizing when it was the right time to get back into the growth fund in time for the phenomenal return in 2021. In fact, many investors only got back into growth assets in the second half of 2021 once they saw how well the market had already done for the year. This was just in time for another extremely difficult year this year. In contrast, look at that average annual return in the last bar. This is the smoothed out return investors have received by just staying put in a long-term strategy that was appropriate to them through the years, good and bad. In the US market, historical data shows that over the past 20 years, 7 of those best days happened within just about 2 weeks of those 10 worst days. So even if you'd managed to sell on one of those worst days, if you'd missed out on one of the best days that were only shortly after, that also would have impacted your long-term returns. So the antidote to the problem of trying to time the market is just to pick an appropriate strategy that works long-term, so you can hold it through all those short-term ups and downs with the goal of achieving that more smoothed out average return over time.
Thanks, Laura. That was very well explained. So it's my turn now to go back to one of our previous questions that was asked, after the previous webinar, which was, could you please explain the relationship between inflation, interest rates, and the Reserve Bank? So obviously this is something that's getting a lot of airtime at the moment. So thinking again about buying and selling, what pushes prices up and what causes them to fall? So prices can rise when there's a problem with supply, such as we've seen with COVID. All those shipping and manufacturing delays due to lockdowns and sickness, they inevitably pushed prices up as there was increased demand relative to supply. And those price rises are called inflation. So on the left-hand side of the slide is a little shopping list of mine, a genuine one from a midweek shop that I did on the 7th of March, 2020. So those items totaled $41.92, and I price checked exactly the same items from the same supermarket last week. I was horrified to see that it would cost $57.17 for exactly those things, which is an increase of 36% overall. Broccoli in particular was up 151%. And that is inflation at work. And I'm pretty sure that nobody's had a 36% pay increase over the last 2 years. But what this little snapshot shows you is that effectively we've all had a 36% pay cut in terms of our purchasing power. It's a direct hit to our wallets, and it's the Reserve Bank's job to fix it. And the way they do that is with a thing called monetary policy. So to explain this, I'd like to use a little piece of my childhood growing up in Wellington, the famous bucket fountain, by way of example. So water flows from a central spigot down into the buckets, which gradually fill and then they tip and empty, and they drain away, only for the water to make its way back up again to the top at the central tap and start the whole process all over again. Okay, so the flow of water through the buckets is like the flow of money through our society. Monetary policy is a process using interest rates as a tap. So when the Reserve Bank turns down interest rates, it increases the money flow. In other words, it becomes we are less incentivized to save and we spend. But if the Reserve Bank turns up the interest rates, that will decrease the money flow. So decrease the money flow, decrease demand, prices drop. It's the interconnectedness of money at work.
Is that still there, Victoria?
It is a very treasured Wellington icon, Cath.
I've been to visit the advisors in Wellington, but I haven't gone to Cuba Mall, right?
It is
recently.
Oh, you'll have to put it on your bucket list. No,
I will.
Yeah, well, I think now that we better understand inflation, it's quite easy to understand why this next myth that we're going to talk about isn't true. Holding on to cash just isn't a safe haven over the long term. This is because, as we've just been explained, and as we are all living in the present moment, unfortunately, the value of cash lessens over time as the price of everything it can purchase goes up. So to maintain or increase the value of your cash, you need to grow its value, at least in line with inflation. So again, you've seen this chart from our last webinar if you're at it, but that is exactly what this chart aims to illustrate. So if you'd put $1,000 into a piggy bank 20 years ago, opened it up today, you'd still have $1,000. So you'd be excused for thinking you'd made a really safe choice. However, pretty much everything is much more expensive now than it was back in 2002. That means in real terms, the value of your cash is actually about halved. In contrast, that top lighter blue line is what would have happened if you'd invested that $1,000 in New Zealand shares over the same exact time period. Yes, the ups and downs can look quite scary, and it doesn't feel very good when you're in one of those short-term dips. But if you had just sort of stuck with a strategy and stayed invested through that full 20 years, you would have still come out not just maintaining your purchasing power against inflation, but actually growing your money instead of going backwards. So of course, there are going to be shorter term time periods where cash comes out ahead of any other options for a short-term return. But if you're a medium to longer term investor, this is very unlikely to be the case. Cash investments still have an important place, particularly for anything sort of shorter term or more immediate needs. But when you've got money set aside for the long term, make sure it's invested appropriately.
Thanks, Laura. Another thing that people who attended the last webinar indicated they'd be interested to understand better is the difference between active and passive management. So managed funds are like a pick and mix bag of sweets, where the fund manager is making the choices as to which sweets go in and out of the bag. And though the value of spearmint leaves or aniseed balls may change from day to day, the overall aim of the game is to grow the size of the bag of sweets. So when you invest in managed funds, you are buying saleable units in a big grouped investment that's valued every day on the net asset value, which is the assets minus the liabilities of all of the investments it holds. So the unit price that you pay to own the units, or that we pay you when you sell them, is calculated by dividing that net asset value of the sum of investments by the number of units on offer. Every time an investor adds money to the fund, the total pool of funds to be invested increases and the number of units on offer increases. So you, the investor, purchase units in managed funds alongside lots of other investors. What happens next? Well, as mentioned before, the fund manager has the task of investing that money on your behalf to generate the capital gain that you're looking for. And the way that she does that is by investing in lots of different assets: property, cash, bonds, equities, and that's how she achieves the diversification that we talked about earlier. So how does the fund manager decide where to invest? This is where things get interesting. Every fund manager has a different view on where the best place to invest is and how they can generate capital gain whilst managing that risk versus return expectation. So a passive fund manager believes that by investing in all the companies listed on the exchange, they will achieve the same return as the market. They don't pick and choose, and it doesn't require any additional effort. Here at Fisher Funds, we do all our own research on the companies before we decide what we want to buy shares in. We analyse the company's financial statements, look at their competitors, talk to over the overall industries and the countries that they operate in. We meet with the people that run the companies. We talk to their competitors and their customers. And what specifically we're looking for is companies that we think are going to grow their earnings for the immediate and near future. And we call this long runways for growth. So growth is not the only thing that we're thinking about when we invest, though. We also think very carefully about the environment, the social impact of the businesses that we invest in, and how these companies treat and pay their staff. Fisher & Paykel, which I was talking about earlier, have got factories all over the world, and how their staff are treated and their working conditions is something that we think is super important. This is active management, and our goal is to outperform the market. And one of the things that I've heard people mention, Laura, is that investing is for someone else.
Yes, yeah, that's our last myth of the day. So I think traditionally, and I know I was like this when I was younger too, many of us have thought that investing is really only for people who are already wealthy. But today, this is really not the case. It's really easy for us to think of reasons why we aren't the sort of person who should be investing. But for most of us, it's just about finding the right option. This is where educating yourself on your options, like you're doing today, learning about investing, doing more research, and ideally getting advice will help set you up to figure out how you can make investing work for you. So, for example, if you think you're too old to make the most of investing, you could consider more conservative options. If you don't have a lump sum to spare, you could consider options that allow you to invest small amounts on a monthly basis. If you don't think you've got the time or the knowledge, you could consider a managed fund, like Victoria was just explaining, where you've got a professional doing the work for you in the background on a day-to-day basis. I mean, there's many ways that we can talk ourselves out of investing, but the point here is to encourage you not to just write it off as an option prematurely. There's such a huge range of styles, structures, and options in the market now to cater to all different types of investors, and you might be surprised what's available to you.
Thanks, Laura. So let's go back to our very first slide, and this is the overview of an investment option, be it for KiwiSaver or a managed fund. In this case, it's for a growth fund. So today we mined down into exactly the sort of detail that is outlined here. We've explained what is meant by growth in this context, what the volatility of returns looks like, why time is important, and we've defined and explained what the different asset classes are and how they work in unique ways to deliver returns, and of course, why diversification is important. You should be able to read that little slide bar, which indicates how likely it is that the investment will experience volatility of returns and why the suggested minimum time frame for the investment is really important. Although we've tried to explain some of these terms to help you read summaries like this in the future, remember you're not alone, and when it comes to thinking about investing, advice is always available if you'd like to talk it over with an expert.
Great, excellent. Thank you both, that's fantastic. And I can see we've got quite a few questions coming in. So I'm going to throw it open to ask both of you some questions. And I'll start with one that's come through early on, which is around, are your financial advisors only available to Fisher Funds clients or customers? So as we mentioned, and as we've talked about throughout the webinar today, we help our clients both with KiwiSaver and managed funds options. And there's no charge for picking up the phone and having a conversation and having advice from us. And then it's your choice around what you'd like to decide to do. So yeah, we've got advisors. I think we've got about 36 advisors now, 30 something. I don't know. We're growing, so it's great. It's exciting. And we've got a team in Christchurch, Wellington, and here in Auckland. So that's the first question. I had a question that came on, which just as you were entering your talk, Laura, around what would you recommend as the best type of investment for beginners who don't have much experience, but maybe you could talk a little bit about KiwiSaver and managed funds and how people should think about that.
Yeah, I mean, the first investment that a lot of people start off with is their KiwiSaver, because of course it's so easy to opt into that through your employer, and there are benefits to being a KiwiSaver investor, like if you're of an eligible age, member tax credit, and you might also get additional employer contributions as well on your own. A managed fund is another option, which is going to be structured quite similar to a KiwiSaver in most cases, but it's a bit more flexible. So if you've got a KiwiSaver, you're locked in until either you buy first home or you're 65 or you're in quite significant financial hardship. With a managed fund, you can invest in a similar way, but have the flexibility to take out money or add money easily as you need to. But in both cases, for a beginner, probably the right place to start is to, speak to an advisor who can help sort of talk through the different kinds of options, how they work for different people with different goals and different timeframes. There's online risk profile type questionnaires that you can do that will help you to choose the right kind of fund. But rather than going straight into direct shares, it probably is a better option to invest in a managed type of fund. We've got a professional in the background actually making those buying and selling choices for you. Great,
thanks, Laura. A question for you, Victoria. And if investing at retirement age, which type of investment is recommended?
Now, I wonder if I'm going to address that question in two parts. So the first part is a type of investment. So should that be a KiwiSaver or a managed fund? Once you are of retirement age, KiwiSaver actually does provide a very cost-effective investment vehicle because you can access it exactly the same way as a managed fund that Laura was just talking about before. The second part of the question is, what asset classes should I invest in? So the beauty of a managed fund, is particularly from a Fisher Funds perspective, is that a managed fund gives you the ability to actually manipulate your strategic asset allocation. So you can get the perfect fit for your risk profile and your investment timeframes with a managed fund, because you can manipulate the strategic asset allocation across cash and conservative or and growth assets, if you like. Whereas if you're investing in a Kiwi saver, those funds are already diversified. So you've got less actual physical control over them yourself. So it really pays in this instance to definitely have a chat with an investment advisor to make sure that the right investment mix is found for you. But there should definitely be no hindrance to investing at retirement age, because as we've talked about, retirement is it's only just the beginning. Retirement age is only just the beginning. And with longevity being such as it is, that it's something that an investment that's probably likely to be a 20-year time frame one.
Yeah, exactly. Yeah, so really good advice there. So have a chat to your advisor and work out about what's the right mix for you to have. Great. I've got a question. Is access available to the previous webinar? Yes, it is. And you can go, I'm pretty sure you can go online and find a link to that. So if not, we'll make sure that it is there. A question here. Laura, would you invest in multiple managed fund companies? That's a good one.
That's a hard question. One.
No, but people, you talk about diversification. So people go, well, should I diversify and put my managed funds with a whole lot of different providers?
Yeah. Well, I mean, I guess there's a couple of schools of thought around that. I mean, one school of thought would be, when you buy a managed fund, it should be adequately diversified within the fund, that you are really quite safe with one provider, provided they're reputable and you've got a good they've got a good track record and you're happy with their investment style. However, if you did want to diversify not just the companies and the asset classes within your fund, but the type of style that your providers have, then investing in multiple managers is one way to achieve that. I mean, some of them might have a more aggressive, more growth focused, concentrated active style. Some of them might be a little bit more passive and have a different kind of selling point. So we do see that.
Yeah.
Great. And there will be that there's certain styles that perform better and worse in different economic environments.
Yeah, sure. Thanks. And I'm gonna throw you another question, which has just come on, so be ready. Laura, why are international shares so much riskier than New Zealand shares?
Okay, that is a good question. Very good question. I wondered if someone would ask that. The reason is New Zealand shares are denominated in New Zealand dollars, and we're New Zealand-based investors. Whereas when you invest in international shares, you've also got currency risk. So some managers might aim to what they say call hedge out the risk. Basically, that means that they have, through complicated structures we don't need to go into, kind of got insurance against the moves in currencies. But a lot of managers actually keep in a component of that currency return, because it can go and consider it just part of the total return of investing in that country. And when you do have currency exposure, in a way, it's an additional form of diversification, because you've now got additional exposure to that other economy as well as a New Zealand economy.
Yeah, great. Thank you. Excellent. We'll have got time for a couple more questions. So Victoria, I think we've had a little bit, this is specifically around cash assets. So someone's saying, I don't have any cash assets currently. What is the best way to get started and how much would I need?
Oh, well, that's really simple. So you're able to open a managed fund with as little as $2,000, or you can set up a direct debit for $100 a month. And so it's a super easy way to get started. And also similarly, opening a Kiwi saver, if you are below retirement age, you don't have to have anything to open your Kiwi saver. It just starts automatically and comes out of your wages as you go. So there's certainly no impediment to getting started today, really.
Yeah. Great, thank you. Laura, I am going to go back to one question which we actually had right near the beginning, which was around your slide around the bonds with the $50. Yeah, we've got a question in here around when do you get the $50 coupon? Is there an easy way for you to explain that?
Yeah, I mean, obviously I was... I don't want to like just completely send everyone to sleep. So we obviously use very simplified examples. Each bond will have its own structure. I mean, for some bonds, the coupon will be paid semi-annually. Sometimes it's annually, it could be quarterly. So you would know that when you buy the bond, what type of bond it is. Yeah, so essentially it's going to vary depending on the type of bond.
Yeah.
But I think the other part of that you might be sort of getting at or thinking about is, if I did sell the bond early, am I just missing out on that coupon or interest payment, or in a case of shares dividend, that I am entitled to if I stick around and hold on to the bond? And the answer is that's kind of incorporated into the price. So it's an additional complication we didn't get into, but it is part of the way that bonds are priced.
Yeah, absolutely. And I think we've got time for one more question, Victoria, which is, are there tools available to determine your personal risk profile?
Yeah, absolutely. And it's a really crucial part of the advice process. It's called an investor profile questionnaire. It's roughly designed to, in quite a short, like 10 questions or less type of thing, and it's only, it's an indicator only. So, as always, it's really best to sit alongside a really detailed conversation with an advisor. But roughly, an investor profile questionnaire puts a number of questions to a potential investor, things that I generally get them to think about. If this scenario was to occur, how would I react? How would I feel? If markets were to drop 20%, would I sell, or would I sit back and do nothing? And it's meant to get the investor to start thinking a potential investor to start thinking along the lines of not worst case scenarios, but a variety of different case scenarios, and really sort of sit with how that would feel, because obviously there's a risk of volatility. Investments do go up and down, and people need to actually kind of to really get to grips with how they would feel in different scenarios, because it's by doing so that they can understand, even if they have a really long time frame, they may be completely uncomfortable with any risk of volatility at all, and therefore a conservative investment is going to suit them best. But again, it's designed to sit alongside a conversation with an advisor to really to get a sense of both timeframes and the risk profile.
Great. That's great. Thanks, Victoria. And you can go online and complete that on our website. So I'm going to finish with this question, Laura, because it just came through and I couldn't help it. So is there an age or stage at which you should change the approach to your investments, e.g. stop pursuing growth and invest more in conservative funds and bonds, etc., when you reach a certain age? So last question to finish us off.
Yeah, it's such a good question, and we really need to make sure that we've give everyone who attended access to that webinar, or have it on our website.
It is on our website.
Yeah,
it is on our website. And this one will go on too.
Yeah. So our last webinar is on our website, and we actually went through each stage of life and different things that you can think about to help maximize your opportunities with investing. But yeah, there's quite a few triggers, obviously. As your time frame decreases, in general, you might need to consider being slightly more conservative. If you need your money for a short-term purpose, you might need to make sure your money is a bit more conservative. Like, for example, some people might start off in their Kiwi saver in a growth fund, knowing that they're very young and they're just starting out. But once they know that they might want to buy a house in the next couple of years, they move to something a bit more conservative. Once they've used their Kiwi saver for their house, then they need to, again, think, okay, what's my time frame? Oh, it's probably pretty long. Back to a growth fund. I think in general, any kind of major change in your financial situation where you've got a lot more or a lot less money, or your sort of goals for the money that you're investing have changed, are triggers to relook at your strategy.
Yeah, fantastic. Great. Well, thank you so much, both Victoria and Laura. It was great to have you here presenting and answering lots of the questions that we've had in. If we haven't got to your question, we'll either get back to you or feel free to contact us and we can help. And we've loved having you join us. And we built this one, as we mentioned earlier, based on the feedback that we had from our first webinar. So please give us any feedback, things that you'd like to see more of or like us to discuss, and we will certainly do our very best to do that. So thanks again and have a wonderful rest of your day. Bye.
Thank you so much.
Bye-bye.